Annuity payout options for the National Life Insurance exam are a critical component of the liquidation phase, where the insurer converts a lump sum into a guaranteed stream of income. You must first recognize that the option chosen by the annuitant determines the size of the monthly check and whether a beneficiary will receive anything after the annuitant passes away. Let us start with the life-only option, which is also known as straight life or pure life. This option provides the highest monthly income of all payout choices because the insurance company takes the most risk that you will live for a very long time. But they also have no obligation to pay out a single cent after you die. On the exam, they will often frame this as a choice for someone who wants the maximum possible income and has no dependents or heirs to worry about. A common trick is to suggest that if the annuitant dies after receiving just one payment, the insurance company keeps the rest, and that is absolutely true. Next, we look at life with period certain, which balances the need for lifetime income with the desire to protect a beneficiary for a specific window of time. If you choose a 10-year period certain and die in year 5, your beneficiary receives the remaining 5 years of payments. However, if you live for 30 years, you keep receiving payments for life, but the beneficiary gets nothing because the guaranteed period has passed. The exam loves to ask if payments stop at the end of the period certain, if the annuitant is still alive. And the answer is always no, because it is still a life annuity and payments continue until death. Then we have joint and survivor options, which are designed for couples. This payout covers 2 lives and continues as long as one of them is breathing. You might see joint and full survivor or joint and 1/2 survivor, where the check size drops after the first death to reflect the reduced living expenses of the survivor. This option naturally offers a smaller monthly payment than life only because the company is likely paying out for a longer duration across 2 separate lives. Finally, we have the refund options, which ensure that at least the original principal is paid out. With a cash refund, the beneficiary gets a lump sum of the remaining principal if the annuitant dies early, while an installment refund pays out the remaining balance in continued monthly checks until the principal is exhausted. A great mnemonic to remember the hierarchy of payout amounts is the phrase, "Life is the largest and refund is the rest." This reminds you that life only pays the largest monthly amount, while refund options ensure the rest of the money goes to the family. Watch out for the trap where the exam asks which option provides the most protection for a beneficiary versus which provides the highest income. Remember that the more guarantees the insurance company provides, the lower the monthly payment will be for the annuitant. If you see a question about an annuitant who wants to make sure their spouse is taken care of for the rest of their life, your mind should go straight to joint and survivor. But if they only care about making sure their kids get back what they put in, then a refund option is the answer. You must also distinguish these from fixed period and fixed amount options, which are not life contingencies. A life annuity always guarantees income for as long as the person lives, whereas fixed period or fixed amount options might run out while the annuitant is still alive. The exam will test your ability to match the specific financial need of a client to the correct payout structure, so always look for keywords like maximum income or beneficiary protection to guide your answer. Understanding these trade-offs is essential for identifying the correct answer when the exam presents scenarios involving risk tolerance and legacy planning.